Worldcom was an American telecommunications company. During its heyday, Worldcom was one of the major long-distance providers in the United States. The corporation is best recognized for its role in one of the country's largest accounting scandals, which came on the heels of the Enron and Tyco frauds.
Corporate collapses are often blamed on greed, corruption, or reckless leadership. But WorldCom's downfall was not triggered by a dramatic heist or a sudden financial crash. It began with something far more dangerous, a quiet, technical accounting choice that almost no one outside the company understood at the time. A choice hidden behind spreadsheets and journal entries. A choice that inflated profits, reassured investors, and delayed the truth until the damage became irreversible. By the time the illusion collapsed, $4.7 billion had vanished, and one of the most powerful telecom companies in the world ceased to exist. WorldCom's story is not just about fraud. It is about pressure from Wall Street, pressure from competition, pressure to maintain the image of unstoppable growth. It reveals how modern corporations can slowly detach from reality, replacing truth with accounting narratives that look legitimate but hide deep structural failure. This is not a story of one bad quarter. It is the story of how financial systems, incentives, and silence allowed deception to become routine, and how one accounting decision exposed the entire machine. Before we begin, like and subscribe if you want more deep, documentary-style breakdowns of business, power, and financial history. WorldCom's rise, growth as an identity. WorldCom did not grow organically. It expanded through relentless acquisitions. Its strategy was simple: buy competitors faster than anyone else, merge their revenues, and present the result as explosive growth. Wall Street rewarded this behavior. Stock prices climbed. Analysts praised management. Growth itself became WorldCom's identity. Bernard Ebbers, the CEO, was not a traditional corporate executive. He was charismatic, aggressive, and deeply invested, financially and emotionally, in WorldCom's stock price. Much of his personal wealth was tied to company shares, many of which were used as collateral for loans. As long as the stock rose, everything worked. If it fell, everything collapsed. The telecom bubble, expansion without demand. During the late 1990s, telecom companies raced to build infrastructure. Fiber optic cables were installed at unprecedented scale. The assumption was simple: internet usage would grow endlessly and capacity would always be needed. But demand did not match supply. Bandwidth prices collapsed. Revenues flattened. Suddenly, the massive infrastructure investments that once looked visionary became financial burdens. For WorldCom, this was catastrophic. Its cost structure was built for growth that no longer existed. Yet Wall Street expectations did not adjust. Analysts still demanded rising earnings. The psychological trap: we'll fix it next quarter. At this stage, WorldCom faced a choice: admit slower growth and accept a collapsing stock price. Buy time and hope conditions improve. Management chose the second option. This is where fraud often begins, not as a grand plan, but as a temporary solution. The belief that the problem is short-term, that next quarter will be better, that the market will recover before anyone notices. Once that mindset takes hold, accounting becomes a tool, not for truth, but for survival. The accounting decision that changed everything. WorldCom's largest expense was line costs, fees paid to other carriers to route calls and data. These were recurring operating expenses, not investments. Accounting rules were clear: these costs must be expensed immediately. WorldCom ignored that rule. Executives instructed accountants to reclassify line costs as capital expenditures, treating everyday operating costs as long-term assets. This single decision had enormous consequences. Expenses were artificially reduced. Profits were inflated. Earnings targets were met. The stock price remained stable. This wasn't a rounding error. It was billions of dollars moved with a few keystrokes. Why this fraud was so effective? The fraud worked because it exploited complexity. Most investors do not analyze accounting classifications in detail. Analysts focused on revenue growth, not expense structure. Auditors relied on management explanations. Capital expenditures sound legitimate. They are normal in telecom businesses. The deception blended into standard financial language. That is what made it dangerous. Internal culture, silence as policy. Inside Worldcom, questioning numbers was discouraged. Instructions came from senior executives, often without documentation. Accountants were told what entries to make, not why. Employees who asked questions were sidelined. Others complied out of fear of losing jobs, fear of retaliation, fear of being blamed. Over time, abnormal entries became routine. Fraud normalized itself. The role of auditors and oversight failure. External auditors did not detect the fraud early because audits are not designed to catch intentional deception hidden by management. Auditors sample data. They do not assume executives are lying. Regulators were understaffed and reactive. By the time red flags appeared publicly, the damage was already done. This highlights a crucial lesson. Financial oversight systems assume honesty. When leadership abandons honesty, the system struggles to respond quickly. The internal audit team, the turning point. Worldcom's internal auditors noticed something strange: massive capital entries with no supporting documentation. When they asked for explanations, none were provided. Instead of backing down, they escalated the issue to the audit committee. This was an extraordinary act of professional courage. They knew what they were uncovering could destroy the company. What they found confirmed their fears. Years of fraudulent accounting entries totaling billions. Collapse and bankruptcy. Once disclosed, trust evaporated instantly. Creditors withdrew, stock trading halted, confidence vanished. Worldcom filed for bankruptcy in July 2002, the largest in U.S. history at the time. Investors lost everything. Employees lost jobs and pensions. The company's assets were eventually sold, and the name disappeared. The human and economic damage. This was not just a corporate failure, it was a social one. Thousands of employees had invested retirement savings in company stock. Communities built around Worldcom offices collapsed. Pension funds and institutional investors suffered massive losses. The damage rippled far beyond Wall Street. Legal accountability.
The accounting department was put under was producing an entry that was based on the CFO's thought process of what he thought the number should be, as opposed to what we knew the underlying answer was.
Bernard Ebbers was convicted of fraud and sentenced to 25 years in prison. Other executives faced prison sentences, fines, and lifetime bans from corporate leadership. For once, consequences reached the top. Regulatory fallout. Sarbanes-Oxley. Worldcom helped trigger sweeping reforms. The Sarbanes-Oxley Act imposed stricter auditing rules, internal controls, and executive accountability. CEOs could no longer claim ignorance. Financial statements became personal legal responsibility. The law reshaped corporate governance worldwide. Why Worldcom still matters. Worldcom's collapse was not an anomaly. It was a warning. The incentives that caused this fraud, stock-based compensation, growth obsession, market pressure, still exist today. Technology has changed. Accounting standards have evolved. But human behavior remains the same. Whenever performance matters more than truth, the risk returns. Worldcom did not fall because of one bad decision. It fell because that decision was allowed to continue, unquestioned, for years. A single accounting choice exposed how fragile corporate truth can be when incentives reward appearance over reality. It remains one of the clearest examples of how numbers can lie, how believing them without skepticism can destroy empires. If you found this deep dive valuable, like the video, subscribe for more long-form investigations into business and financial history, and share it with anyone interested in understanding how power really works behind the numbers. Let us know in the comments which scandal or system you want explored next.